So what we do is we offer a single technology and legal infrastructure for corporates and banks to work together. So it's all about connecting through one party and working with multiple parties. The reason kind of legal is important is we're a bit different from the others where we don't just provide a technology platform, but we've also standardized the legal documentation. The asset classes we work in are typically asset classes that have historically been extremely bilateral between a corporate and a bank, which has meant that those asset classes haven't been very global. There hasn't been price transparency. It's also been costly. So if you think of working capital as an asset class, if you split that into two sections, you think about the bond, the loan, and the CP market. Everyone knows where things price. They know what the documentation looks like, and it's a very kind of standardized market globally. Whereas if you start looking at things like receivables, inventory, and supply chain finance, corporates are dealing with multiple banks, they're signing multiple documentations to get things structured and put together. So what we do is we take that away. We offer a technology platform that's global, that allows you to connect with either the relationship banks you want to work with, or new investors that can offer you a different prospect on liquidity as well as kind of appetite. As well as then creating a legal document that you sign, one legal document that gives you access to the whole market. We've been up and running for about 4 years now. We've transacted about 25 billion or so over the last 4 years, and we are kind of averaging about $1.5 billion a month or so. All our companies are large global kind of multinational corporations on one end, and on the other end, we've got investors that include not just banks, but also institutional money like asset managers, hedge funds, specialty finance companies. And that what we're seeing in the asset class is pretty interesting because historically, this has been very driven by commercial banks, and definitely corporates are still working with them. But we are seeing kind of more investors come in who think about this market as more of a credit market, and it's kind of really opening up the market, and it allows corporates to kind of sell maybe assets that have historically been trickier to monetize. So before going into kind of the technology aspect, just wanted to kind of highlight, technology is great, but also there has to be a reason why someone's using the product. So a couple of things that we're seeing in the working capital space are why corporates are kind of actually using these working capital solutions. So firstly, anyone that has some kind of secured borrowing-based facility, selling receivables is a better way of potentially monetizing it because the advance rates that we're seeing are typically 100%. So it's increased liquidity. But also we are seeing in a lot of cases, companies selling receivables can price way below where they would price their credit facilities at. We're seeing a lot of companies Treasury starting to work very closely with their procurement teams and their sales teams and kind of start taking out some kind of early pay discounts from their contracts. And instead of that, giving people extended terms and monetizing receivables. So we recently worked with a company that was offering kind of 2% at 30 discount terms, which is, if you look at from a P&L point of view, that's about 24% a year. They increased their terms. They started selling receivables at something like, 2.5% all in. And that from a P&L point of view gave them a huge advantage. And then kind of general things, including kind of we see event-driven drawings. So a lot of companies will use us at quarter ends or during kind of M&A situations when they're looking at leverage ratios. And finally, we are also seeing kind of risk mitigation. So anything that we do is normally done on a true sale basis. So it's completely off balance sheet and it's used as a risk mitigation tool. The reason why corporates are using us today is one, it allows them to connect to their relationship banks, but also allows them to kind of access new capital. Two, from an insurance point of view, we offer assets on the funded side from a working capital, but we also have an insurance marketplace that I'll show you a demo of. So we're also seeing companies be able to come out and think of risk as funded or unfunded. And if they're looking at unfunded risk, be able to kind of mitigate risk, again, multi-party through our insurance marketplace. So the main thing that we are actually seeing is what fintechs are bringing is transparency, right? Transparency around who you're working with, but also transparency about pricing that hasn't really existed in this asset class. The legal structure is what I spoke about. And then one of the two other key points is we don't really kind of charge until a transaction is successful, which is extremely key. So people use it very much as a complementary way of accessing capital. They have the tool there. They come and use it when they need it. And given it's a global platform, there's kind of global reporting, which is, again, a key element of what we're kind of, looking to change. From an investor point of view, we are seeing kind of banks or other investors use our platform as well as other platforms to be able to kind of access corporates through one and access assets through kind of one technology platform. Again, reporting is a key kind of complementary tool. We're seeing banks use us as an origination platform, so they have their own origination teams, but they're coming to us as well to get kind of new transactions and also use our technology as a white label solution. So I'm going to take you through a quick demo of the platform. Just given we offer a couple of solutions, I'm going to focus on our receivables platform as well as our insurance platform, how they operate separately and also how they tie in together. So in this case, as an example, here's a corporate coming in. And the platform is web-based, so there's no kind of integration. There's not a lot of technology that goes into it. You can come and access it. And on the left-hand side, you see the various asset classes we offer. So taking the receivables asset class, this is what a corporate dashboard would look like. So it tells you that who the selling entity is, which would be your entity, and what credits you're selling in the market at what price. This is an example of us creating a transaction. So on the left-hand side, you get to pick on a transaction basis who you actually want to work with. And then a couple of key elements. One, you're obviously putting up details on the credit that you're pricing, when you want to get funding. So in most cases, we operate on a T+0, T+1, T+2 type of agenda, and also what the pricing is. So we offer a competitive as well as a bilateral model. So on the competitive side, the corporate's kind of putting two price ranges. You're putting the maximum price that you're willing to accept from the market. And then we've got this concept of a buy it now price. It's really saying to the market that if you can take the whole basket, you can take my whole transaction down. And it's interesting kind of seeing what people say they're going to price at and what they end up pricing at is sometimes different. So having that competitive element is helpful at times. And then from an upload point of view, people have various ways to upload. So you can either kind of upload through an API, but a lot of our clients are using us for manual upload. So just to cut down on the integration, they come in, they access a web-based platform, and they just upload a CSV file. They select the invoices they want to sell, and now that transaction's in the market. So it kind of takes a couple of minutes to kind of get up and running. And then this is what a bank would come in and see. So, they see all the assets that are out there in the market, and they kind of see the dashboard. So they get the data you've put up. It tells them, what invoices are for sale. It also tells them what the value of the basket is and what the pricing is. And banks have two choices. They can either come in and offer a bid without some kind of insurance cover, or they have a choice to actually go to the insurance market and get a quote on the asset so they can actually cover it with some kind of risk mitigant. So this is what connects into our insurance market, and they can RFQ the underwriters directly, get a bid from the insurance market, and that actually kind of ties it into the transaction. And we're seeing this actually really work where it's really kind of increasing what people's liquidity appetite is, both from the banking sector as well as from the institutional money, if they can get an insurance kind of cover on these assets. And then it's simple as a bank would put in kind of what they want to buy at what price, and then you start populating a bid book. So it's a competitive-based platform, and you can see other bids coming in. So as a corporate, you'll see the bids coming in, but as a bank, you'll see if you've been outbid, and then you can actually go in and rebid for the asset on the platform. In this case, what we're going to do is kind of submit the bid, and that's the transaction done, and the corporate gets the funding the next day. So leading you to our insurance platform, I've shown you an example of where insurance and funded and unfunded assets can be used together. But this is what we've done on the insurance side. So we partner with Marsh as a broker. And the first time we've actually brought trade credit insurance electronically from a multi-carrier point of view. So corporates that are looking to just mitigate risk without getting actually funded assets can come into our insurance market. They can access multiple underwriters from the market, and they can kind of also go to them and kind of request a quote of an asset they actually want to kind of protect from a risk point of view. So very similar situation here, but this is a corporate going directly, populating the information and going on to the insurance market and just getting quotes back around what the appetite in the market is and being able to accept it. The insurance angle is interesting because today there's no one in the market that actually offers trade credit insurance electronically. And not only do we offer it electronically, but you have a full record of exactly what you've traded, who's traded it with you, what your endorsements are. and it allows people to look at risk in two ways. So either you sell risk and get cash up front, or you just kind of cover risk from an insurance point of view. We have over kind of 60 clients on the platform that's split pretty equally between corporates and banks. Like I said, most of our clients are companies that turn over $1 billion and above. So they're kind of large global corporations. And then from the investor side, we're seeing a lot of players from the banking market, but we're seeing this huge influx of capital from kind of the asset management and the institution money world.